Tracking the Indian equity market in 2025 means feeling the whiplash. Small caps soar one month, large caps claw back the next. Valuations are stretched tight across every segment right now, and global uncertainty makes it incredibly easy to freeze up and do nothing at all. Volatility is the natural state of the market. Panic selling or retreating to the sidelines entirely will sabotage a 10-year horizon far more than any temporary dip. This chart shows exactly why. The jagged, chaotic line is the short-term market, unpredictable and stressful, but layered over it is the math of 10-year compounding, which smooths out the noise into a steady upward climb. Over the last decade, specific mutual funds have quietly compounded wealth at 15 to 20% a year, even through sharp corrections. It proves that time in the market consistently beats trying to time the market. You don't need a complicated portfolio with dozens of specialized bets. What you actually need is a simple, sensible watch list of 4 fund categories, evaluated strictly by how much risk you can stomach. Surviving the next decade means ignoring whichever fund has the highest trailing returns today. Instead, you have to match the volatility profile of the fund to your own psychological breaking point. We start with large cap funds, your stability engine. These invest in India's biggest 100 established companies, places like HDFC and Reliance, which have the balance sheets to absorb economic shocks. Look at this matrix. Averaging a 14.5% annual return, a top-tier large-cap fund is a reliable safe harbor when markets drop. The trade-off is a capped ceiling. With low volatility, you must accept lagging behind riskier assets during massive bull market rallies. Mid-cap funds are your growth gear, investing in agile companies in fast-moving sectors. Taking this risk pushes your compounding ceiling higher, historically delivering near 18% over a decade. But this growth exposes your portfolio to deeper drawdowns when the market corrects. Moving your money from large caps into mid-caps is a direct, conscious exchange. You are trading your short-term psychological comfort for a higher financial ceiling down the road. At the far edge of the risk spectrum are small-cap funds, the aggressive niche. These target early-stage companies and absolutely require a strict 5 to 7 year minimum lock-in mindset to work. The draw here is maximum potential. As row 3 shows, historical benchmark returns for small caps approach an aggressive 18.8%. The trade-off means massive short-term drops in value. You must endure long stretches of underperformance without abandoning the strategy at the bottom. For investors who know they will panic during those drops, we pivot to the direct opposite strategy. Multi-asset funds act as your tactical cushion. Instead of holding only stocks, these funds dynamically shift your money across equities, debt, and gold. The result is a drastically smoother ride. You get softer drawdowns, though it costs you slightly on the top end, bringing returns back to roughly 14.8%. Small caps demand a cast-iron stomach to reach their peak numbers, but multi-asset funds provide the vital shock absorbers required to keep nervous investors from quitting the market entirely. Knowing which category to pick is only half the battle. Executing it effectively over 10 years requires a systematic investment plan, or SIP. And right now, the tax code heavily penalizes a trading mindset. If you sell your mutual fund units within 12 months, you trigger short-term capital gains tax. That penalty just got steeper. In the July 2024 union budget, the government raised the short-term capital gains rate to 20% for resident individuals. To avoid giving up a fifth of your profits, you have to cross the long-term capital gains threshold by holding your investments for more than a year. Under Modi 3.0 policies, long-term gains exceeding 1.25 lakh rupees in a financial year are now taxed at a much more manageable 12.5%. It's worth noting the critical cutoff date was July 23, 2024. Anything sold before that was grandfathered into the older, slightly lower tax brackets. Even with these recent rate hikes, a long-term SIP remains one of the most tax-efficient structures for compounding wealth in India, but only if you refuse the urge to sell early. So stop chasing peak historical returns. To choose your fund, you only need to answer one question. Who are you when the market crashes? Let's map your decision on this flowchart. We start with your primary 10-year goal. Is it capital protection or maximum wealth? If you route toward capital protection, the path leads directly to either multi-asset or large-cap funds. This is for the stability seeker, or the beginner, who correctly prioritizes a good night's sleep over trying to beat the benchmark averages. But if your goal is maximum wealth, you hit the ultimate gatekeeping question. Can you completely ignore a 30% drop in your portfolio's value? If the answer is an honest yes, you are an aggressive optimizer. You've earned the right to hold highly volatile small and mid-cap funds. If the answer is no, you are a core builder. You want growth, but since you might panic, you must stick to large caps. The best mutual fund does not exist in a vacuum. It only exists in direct relation to your emotional capacity to survive a drawdown. The Indian market is currently positioned to reward those who can maintain their discipline through the next 10 years of inevitable cycles. Success does not require dozens of exotic funds or perfect timing. It requires a focused watch list built on honest self-awareness. Take the category that fits your stomach, automate your SIP, ignore the daily noise, and let a decade of time do the heavy lifting.